All right, let's dive into the current state of the US economy. And I can tell you the data we're seeing on the M2 money supply is absolutely staggering. Now, this chart shows the M2 money supply, which is a key indicator of the overall liquidity in the financial system. And folks, what we're witnessing here is nothing short of explosive growth. Over the past decade, M2 has skyrocketed from around $8 trillion dollars to now over $21 trillion. Dollars. That's a more than 150% increase, and it's happening at a pace we've simply never seen before, not even during the height of the 2008 financial crisis. Now, the implications of this are profound. This level of monetary expansion is fueling rampant inflation, as all this excess liquidity makes its way into the real economy. And the concerning part is that the Federal Reserve seems intent on continuing their aggressive rate hike campaign, even as cracks start to show in the financial system. History has shown us time and time again that when the Fed tightens into economic weakness, it invariably leads to a recession. And with M2 growth running this hot, I can tell you from experience, we're setting the stage for a major downturn. The smart money has already started positioning defensively, and if you're not doing the same, you're going to get caught in the crossfire when this all unwinds. Now let's shift gears and take a look at the silver futures market, because what we're seeing here is a textbook example of investors seeking safe haven assets in the face of growing economic uncertainty. As you can see, silver prices have been on a steady uptrend, breaking out to new multi-year highs just this week. And there's a very good reason for this. Silver is often viewed as a hedge against inflation and market volatility, and with inflation running rampant and the threat of a recession looming, investors are flocking to precious metals as a means of preserving their purchasing power. But what's really interesting here is the speed and conviction of this move. The silver futures contract is up over 5% just in the past month, and the volume profile shows institutional investors are aggressively bidding up prices. This tells me that the smart money is preparing for a significant market downturn, one that could potentially rival the 2008 financial crisis. When you see this kind of flight to safety, it's a clear signal that the market is pricing in serious economic turmoil on the horizon. And as an experienced trader, I can tell you this is precisely the type of environment where precious metals tend to thrive, even as traditional asset classes get hammered. Keep a close eye on silver. It could be one of the few bright spots in an otherwise gloomy economic landscape. Now let's shift our focus to the US housing market, because the data we're seeing from Redfin is nothing short of jaw-dropping. According to their latest report, there is a staggering $698 billion worth of homes sitting on the market for 60 days or longer, an all-time high. Now, what does this tell us? It tells me that homeowners are increasingly unwilling to sell their properties at current market prices, which is a clear sign that the frothy housing boom we've witnessed over the past few years is starting to cool. Buyers are pulling back, and sellers are refusing to budge on their lofty asking prices, creating a standoff that is only going to exacerbate the coming housing downturn. And make no mistake, a housing downturn is precisely what's in store. When you couple this data with the rapidly rising mortgage rates we're seeing, it paints a very worrying picture for the real estate market. Home buyers are being priced out, affordability is plummeting, and now we're seeing sellers dig in their heels. This is a recipe for a significant correction, one that could have far-reaching implications for the broader economy. As an experienced trader, I can tell you that the housing market is often a leading indicator of where the overall economy is headed. And right now, the signs are flashing red. If you're invested in real estate-related assets, I would strongly urge you to start reevaluating your positions and positioning yourself defensively. All right, let's take a look at the US 30-year Treasury yield, because this chart is telling us a story that should have every investor on high alert. As you can see, the yield on the 30-year Treasury has been steadily climbing, recently breaking above the 4.9% level. Now, what's so significant about this? Well, the 30-year Treasury yield is often viewed as a proxy for long-term economic growth and inflation expectations. And when we see yields spiking like this, it's a clear sign that the market is pricing in a significant deterioration in economic conditions. Historically, sharp increases in long-term Treasury yields have been a harbinger of recessions. In fact, every single recession since the 1950s has been preceded by a rise in the 30-year yield. And the speed at which we're seeing this move higher is particularly concerning. It's happening at a pace we haven't witnessed since the early 1980s. What this tells me is that the bond market is screaming that the Federal Reserve is behind the curve in its fight against inflation. The central bank's aggressive rate hikes are starting to take a toll, and the yield curve inversion we're seeing is flashing a clear warning signal that a recession is on the horizon. If you're not already positioning your portfolio to weather this storm, I'd strongly encourage you to do so because the writing is on the wall. And finally, let's take a look at this tweet from renowned investor and author Robert Kiyosaki because it perfectly encapsulates the economic environment we find ourselves in. Kiyosaki, the author of the best selling book Rich Dad, Poor Dad, is warning that the